Hello and welcome to Portfolio Playbook. Today is August 30th. I'm Damanick Dantes, founder and portfolio manager at Dantes Outlook. And here's what came across our desk this week. Let's start with US interest rates. We are focused on more of the long term here at Dantes Outlook. If you haven't noticed, we like to remove some of the short term market noise. And at the end of the month, we get some really good data to digest. And I'm looking at a long term chart of the US 10-year Treasury yield. We definitely are in breakout mode still from a structural decline in interest rates, and we see the 10-year yield anchored around 3% or above 3%, stuck in this tight range so far. But if we zoom out, we can see that the upside and momentum following the 2022 interest rate hike cycle has slowed from positive and now drifting downwards. To find a similar situation, we would have to go back to about 1982. And if you remember, 1982 was the end, or pretty much marked the end of an aggressive interest rate hiking cycle to fight inflation. And that's when the Fed was really rewarded or applauded for ending a period of high inflation. Now, the subsequent effect of that was a painful, significant slowdown or recession, significant unemployment, financial market stress, considerable progress, of course, already made in reducing inflation, but that came at the expense of slowing economic growth. And for us as investors, if we're expecting that type of interest rate declining cycle to occur, we would have to expect also a recession, and that would trigger a long duration stance in our portfolios. We don't see that, which is why interest rates have remained elevated or anchored around this level. So we are comfortable with the intermediate term duration. And I want to stress that point significantly. Duration requires some sort of a recessionary impact. And if we're not seeing that, we're not taking the positions in our portfolios. We are comfortable with where we are with our interest rate stance for now, and we'll let the model see what occurs over the next few months or the next year at least. So now going into what our research partners are saying from the macro level, Deep Macro, one of our research friends, suggested that the Fed remains wary of easing too quickly. The markets are still expecting the Fed to cut soon, but inflation has not cooled enough. Again, confirming what we're seeing in the charts. That's keeping US interest rates elevated and the dollar, over the short term at least, supported. Positioning data from MentorQ shows systematic funds have leaned heavily into equities, with their allocations in the US and Europe near record highs. That's telling us that risk appetite is strong, but it's also getting a bit crowded as we enter seasonal weakness. Meanwhile, Chinese equities, they staged a rebound. HSBC analysts noted that the discount between Hong Kong and mainland shares has narrowed to its lowest in 5 years. With better earnings, policy support, and household savings still on the sidelines, to us, both of those markets look constructive. And here at Dante's Outlook, our breadth models, and just to confirm, breadth means the underlying participation of stocks within an index having an uptrend. Short term, the indicators are overbought. And that means that there's increasing risk of a pullback in US equity markets at least. But our long term breadth markets are still in expansion mode. That keeps us constructive on the trend, buying on the dips, and our moderate portfolios outperformed in August proudly, helped by cyclical stocks, intermediate term treasuries, as we stated before, and some select emerging market equities. The aggressive strategy, however, gave back some ground on our crypto holdings, but it remains strongly positive year to date. And now turning over to some longer term investment consideration. Bonds again are back, and Vanguard's analyst has pointed out that even if the Fed starts cutting later this year, yields are unlikely to fall back to rock bottom levels over the past decade. Again, that's what I introduced in this podcast. What does that mean? It means that fixed income once again provides meaningful income at high starting yields and perhaps some stability in portfolios. So you can still navigate this without an aggressive interest rate cutting cycle or an expectation of a recession. Fixed income still offers some strategic advantages in a portfolio. The analyst at Vanguard highlighted that municipal bonds and investment grade credit are still attractive, and the sweet spot, in their view, is in bonds maturing between 5 to 6 years, the middle or what we call the belly of the yield curve. That area balances income with interest rate risk, and if the Fed cuts sharply, investors can still benefit from price gains. On equities, Morningstar research shows the challenge active managers face in outperforming a benchmark dominated by the Magnificent Seven. We've all been accustomed to this, right? And even as stocks stumble, many funds still carry heavy exposure to these names. That limits their ability to pull ahead. And that makes indexing a strong foundation, while selective opportunities remain in what we see industrials, financials, healthcare, the broadening out of the market, where our momentum models are pointing to strength. And the takeaway here is stay disciplined. Revisit some of your bond allocations, leaning on indexing of core equity exposure or equal weighted exposure, and look for targeted opportunities without stretching too far for yield and risk. That's all for now. We'll come back with some of our performance and positioning stats for the next month. Have a great weekend, everyone.